Okay, so here we go. Now, we dealt with chapters 1 through 4, which learning is basically we learned about the basics of accounting. What are the necessary contents that you do need that wrap around the reasons why we do all these things? So, especially with journalizing, okay? Now, today we're going to dive right into looking at the first section of a company, which is our primary, which is sales and obtaining our inventory in order for us to sell. Okay, so chapter 5 is going to be all about purchasing inventory. And then chapter 6 will be talking about selling the inventory. Okay, so one step at a time. All right, so let's go dive right into inventory and what inventory is. So once again, we are looking as if we are a merchandising type of business activity. So we are looking into selling a product. Now, what is inventory? It's pretty straightforward. Inventory is when you purchase goods that you plan to sell in the future, okay, for whatever product or whatever it is that you are going to be selling, right? Whether you're a clothing store or a grocery store, right? You need to obtain inventory, okay? It's very crucial because the ultimate goal is you want to keep track of your purchases, right? Because when we purchase our goods, right, we convert the cash into goods, right? And our goal is to convert those goods into sales, which then convert those sales into cash, all right? And once again, we're looking at retail stores or wholesalers. So yes, these are the type of businesses that do primarily merchandising inventory. Now, the one thing that we have to do here is that when we decide or determine, right, what the cost of the goods is, right, every time we sell it, right, we want to make sure that we sell it at a higher price because obviously the goal of purchasing your inventory is not to sell it at whatever cost value you had it for. You're not trying to break even here. You're trying to make sure that every sale that you do purchase, you want to make sure that you make a profit. Okay, so again, it's converting cash into goods, which then you turn goods into sales, which then you turn sales into cash. Okay. So let's talk about what is going to be included in merchandising inventory, okay? So here is the definition. It's going to be every single cost it takes you to get the asset to the store, okay? Now, those kind of costs, right, can include, number one, the selling price, obviously the purchase price that you're buying the item for, right? Other things that could be included could be sales tax, could be freight charges, could be shipping and handling fees, could be even storage fees, all right? If you are trying to purchase the inventory and you need it as soon as possible, you might have to pay expedited fees, okay? There's a lot of things that you might have to go through, especially if you're purchasing these items or, purchasing from foreign countries. You might have to go through customs and have to pay that foreign fee for purchasing items from a foreign country. So there's a lot of things that can go in between the total cost of the goods sold. So everything that's going to be included to get the asset to the store. So with that being said, right? Now here's a food for your thought here, where sales tax, depending on the relationship of who you are, right? Oftentimes sales tax can be exempt, okay? Especially because your job is that you are reselling it back out to the public. So you're purchasing it from a wholesaler or a manufacturer, which they can waive that sales tax fee because at the end of the day, that sales tax is going to be taxed through you, right, as the retailer. So as far as that, there are a lot of occasions where you can be tax exempt for purchasing those items, okay? So a good example is Well, Costco used to do this where anybody that owns a business license or a business credit card, they can apply for their Costco business credit line or their credit card, and they can purchase anything from Costco with sales tax exempt. Now, nowadays, right, since Costco is now for the public and mostly for the public, right, they're forced to start charging sales tax no matter what it is, okay? Now, there's other places that you can purchase your items for inventory with getting tax exempt, like things like, I think Restaurant Depot doesn't do it anymore, just because you can apply for their business credit card or the business card owner or membership, whatever, and it gives you basically a validation, or it gives you that tax exemption, right? But that doesn't mean that you cannot get taxed, right? For example, if I were to buy a lot of my inventory items by just going to the store, right, I may be subject to pay tax to be able to walk out the door, okay? Any questions here? Okay. So now we're going to talk about freight costs, okay? Now, as far as this is just so then you guys can understand how freight works and how freight gets charged. So in this case, right, we have where the transportation from the seller store all the way to the buyer store, okay? So the seller is obviously the person that you're buying from, right? They're going to be the seller, right? They're selling you the product, and you are the buyer. So this is how it's split into this diagram right here, right? Now, when the seller, okay, it makes it from the store all the way to the midpoint, right? Before it transfers ownership, right? We call that FOB shipping point, okay? That means the ownership is still with the seller because it hasn't left the middle section yet, right? It's transferring titles over. But if you did not know this, right, the buyer is responsible to cover the cost to get it from the seller store all the way to the midpoint, okay? And then once it gets from the midpoint all the way to the buyer's store, right? We call that FOB destination. This is where ownership of the items, of the inventory items, gets transferred. Okay, so this is where it becomes from the seller's possession into the buyer's possession. And however, the seller is responsible to pay for the shipping to get from the midpoint all the way up to the buyer's place. Okay, now think of it this way, right? If you have a total cost, right, when you do shipping, right, especially when you like have to pay a price, okay? Now normally you don't see this because it's behind doors. It is a two-way part when it comes into freight, okay? Now some stores may charge like a flat rate, making you pay for the whole thing, but really it isn't them paying for the whole thing. They're paying for just the portion to bring it from the seller's store all the way to the midpoint, okay? So, and freight is expensive. You know, if you're trying to ship out something so small, it could be anywhere from $8 flat rates to almost $20, $50, depending on how big the box is and how heavy the items are, and if you are having it priority shipping, fragile shipping, whatever it is, right? Whatever handling cost there is, right? Now, in this kind of concept, right, let's try to understand it in a real life scenario. When you purchase anything from Amazon, right? Why is it that when the item never gets to your house and you call and complain about that, and their first thought is, I'm so sorry you never received your items, okay? To make it better, how about we refund you or we send you a brand new product, okay? That means they're taking the loss and they're claiming responsibility because, once again, the ownership of the item gets transferred in between. However, the responsibility to get from the midpoint all the way to the buyer's store, it's the seller's responsibility. Okay? So in this case, that is exactly why Amazon are always going to be willing to, give you back your items or, give you a refund for that point, right? That's also in other terms like customer to buyer relationship, right? They want to make sure that you're still in good terms with Amazon. But in this case, that's because the Amazon is responsible to make sure that when it leaves that midpoint, it gets to your store so it can transfer over the ownership and title. Okay? But if you never receive it, therefore, you never had it in the beginning. So in that case, that's why the seller is responsible to pay for the shipping to get from the midpoint to the buyer's store. Okay. Now, there's also two different ways that we can look at shipping, right? We have two of them. They're called freight on board, FOB for short. And then we have COD, which is cash on delivery, okay? Now, it just depends on whether the company has a third-party vendor. Okay, so most cases, right, a great example is that Amazon, they actually have their own shipping company, right? They actually have Amazon people. They even have Amazon actual drivers, right, that get paid on the job to just deliver packages, right? That is coming from their company. So therefore, they do not charge you separate cash for delivering the items, okay? Now, other places who have third-party vendors that reach out to someone else that isn't part of their company to ship these items to you, they have a possibility where, hey, my responsibility is I'm supposed to deliver these things to you, so you are responsible to pay for those items. Okay, and that's what's called cash on delivery. Okay, so for many businesses out there, cash on delivery could be a very common one that you do see out there. But for smaller businesses or bigger businesses like Amazon, that cost is already going to be included with their service. Okay, as in like Amazon is just one whole entire thing where they provide you the goods and they provide you the delivery charges too. All right, it's just other companies that can't afford it or don't want to pay for a liability to have a car and having their employees injured on the job. They'll just usually they'll have a third-party person who just does it for them, but their only difference is that they're completely separate from that company. So they're still completely separate. They can charge you for cash on delivery. Okay, any questions there? So now we're going to dive right into understanding inventory and how we keep track of it. Okay. So under this, right, we have two different types of tracking methods to calculate or just to keep track of your inventory, okay? We have periodic inventory and we have perpetual inventory, okay? Now for this first chapter here, chapter 5.1, we are going to be focusing primarily on periodic inventory, okay? Later on, when we dive into chapter 7 and chapter 8, that's where we'll talk about perpetual inventory, okay? But for this test, I need you guys to know that there's two that exist, okay? We have periodic and we have perpetual tracking methods for inventory, okay? Now let's go ahead and break down each and every single one of them. All right, periodic, right? Just like in its definition, right? You check on it often. You don't do it as often or you do it every occasionally, right? You do it periodically, every once in a while, okay? So if we keep track of our inventory every once in a while, right? The idea here is that usually you will always take an actual physical count of the items that you have left in inventory at the end of a given period, all right? Now, most cases, a lot of clothing stores, they usually do that at the end of the day. Most grocery stores, right, they just pretty much run it through their system to make sure if they have, how many pallets of one item do they still have left, okay? So usually That is a way that you can keep track of your inventory by taking in a physical count at the end of a given period, okay? In other words, right, you can also treat as if periodic inventory is an item you don't really care too much to keep track of, okay? All right? And here's the big difference between the two. All purchases are going to be recognized as an expense to the company, okay? And then at the end of the given period, when you take your physical account, that's where you need to have a conversion entry to let people know, or the company know, how much items you actually have in inventory at the end of the given period, okay? And that's going to be called periodic inventory, okay? We're going to recognize the inventory as expenses, okay? Whereas perpetual, right? If you look up the definition of perpetual, it means constantly. So if that's the case, if we're constantly updating our inventory, meaning that we're going to keep so good track of our inventory that whether it's every day or every week or every bi-weekly, whatever your accounting period is, right? You should know how much inventory you should have at hand at all times, because here's the catch. Any purchase, you're going to update your inventory. Any sale that you make, you're going to update your inventory. Any returns and allowances, you're going to update your inventory. Any discounts, update your inventory. So in this case, you're constantly updating your inventory based on every time you do a transaction dealing with this particular inventory. Okay, so maybe if you want to understand it this way, perpetual is more along the lines where you have to keep a good track record of this item, because it's one of those popular items that sells out often. All right, so if it does do that, then you know exactly what to do, right? Every purchase that you make, every sale that you make, it's going to be recorded and updated into your inventory, okay? And here's the thing. Here's the greatest catch here. The biggest difference between the periodic and perpetual is that we actually recognize the inventory items as inventory. Straight away, it gets recorded straight away as inventory, right? So that's the difference. Periodic, it's an expense, and we have to have a conversion entry at the end of a given period when we find out, when we take a physical count, how many items you actually have left, and then you convert those items into inventory. Whereas when we look at perpetual inventory, it's immediately put into inventory, it's taken out from inventory, it's added back into inventory, okay? So in this case, that's the difference. One is recorded as an expense, the other one is recorded as straight inventory. Okay? So let's go ahead and dive right into periodic inventory, okay? So we're going to first recognize here is that this example here, where on July 1st, XYZ company, right, purchases 100 units of toys from Toys U, okay? And then it costs about $5.65 each, with a freight cost of $100, okay? Purchase was made on an account, okay? Record this transaction, okay? So here are the two things that you're gonna need for this scenario, okay? I'm only gonna talk about purchase expense and freight expense, okay? No sales tax, no shipping and handling, no foreign taxes, no storage fees, none of that. Because I just want to make sure that you guys understand the simplest kind of understanding, just the purchases, the very basics, okay? When you go into level advance of accounting, that's where you're going to be introduced to more features and more fees that are going to be applied to the cost of your inventory, okay? But in this case, we're only going to look at 2 out of the list that we saw earlier, right? No sales tax, no no storage fees or no anything like that. We're only focusing on purchase expense and freight expense. Okay. So here, right, purchase expense is one account and freight expense is going to be another account. This is where another difference here is that when we look at the cost and all the extra costs that in order for you to get the inventory items to your store is that we're going to separate each cost. Okay. So let's go ahead and take this example here where we purchase 100 toys at $5.65 each. So our very first thing here is that we recognize it's an expense, right? Expenses are normally increased with a debit. So there you go. That's the very first thing I'm going to recognize is I'm going to debit my account for the $565, right? For the 100 toys that I purchased. Right? That's the very first thing there. Second thing I'm going to recognize is my freight expense, right? How much was my freight cost? It was exactly $100, okay? And last piece of information is that I purchased it on an account. So therefore, I owe XYZ company, right? Or I'm sorry, we're XYZ company. We owe Toys U on an account, which is an accounts payable, right? It's a liability because we owe the money. A grand total of $665 even. Okay. Good, everyone good? So that's it. That's how we journalize a purchase of inventory. Okay. Any questions here? It's pretty straightforward, pretty easy. Okay. All right. Now, of course, when we purchase our items, we can also have discounts, right? So when we talk about discounts, right, we're going to be introducing to what's called terms, right? Which we've seen before in QuickBooks, right? It's 2%, 15, net 30, meaning we would get 2% discount if we pay within the first 15 days. If not, the whole bill is due within 30, okay? So once again, as terms can be applied to both vendor and customer. In this case, we're looking at purchases. So that means we're buying the materials from this vendor, and the vendor decides to grant us a very nice incentive saying, hey, if you pay me within 15 days, I'll give you a 2% discount on your total purchases. All right? If not, then the whole bill is due within 30 days. Okay? So usually, especially when you go into vendors like these, they'll kind of give you those kind of options that you should pay within the 30 days, okay? Or whatever term that they give you. Okay? Now, when we talk about applying our discount, right, there are two methods that we can use to apply the discount, okay? First one's going to be net method, okay, where you take the discount immediately, okay? And then you have your gross method, which you take the discount later. Now, the best way to understand what these means is think about your paycheck, right? When you receive a paycheck in the mail, right, you're going to have your gross earnings and then you're going to have your net earnings, right? Your gross earnings is going to be every penny that you've earned from that company, okay? Where the net method is after taking all those calculations, all those taxes out, and all those deductions, you're going to get your end result, which is your net pay, okay? So your gross pay is what you're going to start out with. Your net pay is what you're going to take out immediately and calculate how much you're supposed to actually be receiving. So in this case, that's the exact same idea here, all right? Where in this case, when we recognize our discount, right, when we see terms, you have two options on how you want to journalize it, right? You can either journalize it as the net method, where you take the discount automatically and then, journalize it that way. Or you can use the gross method where you journalize it regularly, and then when that time comes, whether you met the discount or not, that's where you apply the discount when you meet that discount date, right? Now, in better ways to understand this, I would recommend as beginners, okay, especially for small businesses, that you should definitely use the gross method because once again, if you're purchasing inventory, inventory can cost you a lot of your money, okay? And especially if you're buying thousands of items, right? You can only imagine then that means the cost of it could be really expensive just to purchase your inventory. So in that kind of case, right, for small businesses who, cannot afford or possibly, they have other priorities, right, such as rent expense, they have to pay those things first. So in this case, right, a gross method would be the highly recommended to use because if you pay and you made the discount, then you get to take the discount. But if you just pay regularly, right, you have a deadline. You have to pay within 30 days and that's it, okay? Where the net method is for people who are, or I guess companies who are that's better manageable for their finances, right? If they can afford to pay for it, or if they have like a lump sum of money that they can just start paying everything off instantly, right? Then that's going to be ideal for a net method because then they don't have to put in an extra journal entry just to record the discount, okay? Now, what does all this mumbo jumbo mean? Well, I'm going to go ahead and show you right now, okay? So let's going to focus on the gross method first. Let's do this one first so we can recognize how we do it first, okay? So in this case, right, we have an example here where on February 1st, okay, you purchased 100 coffee mugs, okay, on an account from Cuppy's Co., okay? And each one costing $1.25 each, with the freight costing you $100, okay? Now, terms were given 5%, 10 net 30. So they give you 10 days to pay so you could take that discount, okay? Now, let's go ahead and record this transaction. So in this case, because we're using the gross method, right? We're not going to take a discount yet. We're going to take it later, okay? So if we're taking it later, then this is how we're going to journalize it, okay? So first things first is you're going to recognize the date, which is February 1st, okay? And we're going to recognize that we purchased 100 coffee mugs at $1.25 each, okay? So therefore, right, we're going to recognize our purchase expense, right, because we're doing gross method. We're not going to take the discount yet, okay? So here, we're going to recognize my purchase expense is going to be for $125, okay, plus my freight of $100 to give me a grand total of $225 on an account, okay? So that's the very first step here under the gross method is we're just going to recognize it exactly for what it is, right? Just like when you get a paycheck, you're going to recognize for exactly what you've earned, okay? Then the next thing is, well, now it is scenario number 1, right? Let's say it is February 9th, okay? And you decide to pay Cuppy's Co. for your purchase of inventory, okay? So in this case, right, you already know your terms are 5% net, 5% 10, net 30, okay? So I have until February 10 to pay in order to get my discount. And in this case, I paid on February 9. So therefore, I get to take my discount, okay? So this is straightforward, pretty easy here. So this is what's going to happen, right? Since I made the discount period, right? I made the discount cut. Therefore, I don't owe Cuppy's Co. $225. In fact, I'm going to write them a check that's less than that, right? Now, in this case, right, so if I owe Cuppies Co., right, from the previous one, I owe them $225, okay? Now, if I get a 5% discount, what am I going to discount? Am I going to discount the whole entire $225? Or is there something I have to do in order for me to calculate my actual discount? What can I discount?
125, no?
You can only discount the original selling price. That is correct. So in this case, right, I can only discount on my actual purchase of the cups, right? Because we talked about this. You cannot ever take a discount on freight or shipping or handling or even tax. You can't do it, right? It's, like I said, you go to UPS or FedEx and you ask them for a discount, they're just going to laugh at you because you can't take a discount. So in this case, you can only discount off of the actual purchase price itself. So in this case, I'm going to take 5% of 125. And how much is that?
$6, something like that.
Yes, $6.25. Now, here's how we got to do it, right? In my books, right, I show that I owe a total of $225, okay? Now, in this case, right, my check or when I make a payment to them, I'm not paying them $225. I'm going to pay them $6.25 less because that's how it's supposed to be. So in this case, this is how you're going to journalize it, right? Because in your books, you already claim that you owe them $225. However, because you're paying within terms, they must discount you for those $6.25. So this is where we're creating a contra account called purchase discount to record that extra discount, because here in my books, I'm not paying $225. I'm only paying them $218.75.
Can I do a cancellation or reverse, like when you purchase anything?
What do you mean by that?
Like you return something or you have a mistake when you remember you reverse or you can cancel and you can do it back when you pay.
In this case, no. This isn't an error because we're not returning anything. Are we?
No, but you pay a minus, so it's a kind of I don't know, a cancellation, something like that. No,
It is.
actually,
It is not.
it's it's like you buy, but you can do it like you buy again the same product for that price. So
Okay.
no, is it possible? It's not. No, it's just a question. I don't know if it's possible or not.
No. In this case, no. You do. That's not how you do it. Okay. In this case, we have to create what's called a contra account. Okay. Contra account, which is a contra account to purchase expense. Okay. So this account is going to decrease your original purchase expense. Okay.
Yes.
And in this case, we're not going to reverse and re-entry because that's even more work than necessary. Okay? In this case, right? I'm getting the discount because I made the discount, okay? We'll talk about scenario 2 afterwards. Okay? I made this discount. And because I did good record keeping, right? I deserve this discount. So I'm going to send them a check for the discounted amount because I met the terms. Okay? Now in this case, right? This is how I record it because in my books and their books, I owe them $225. But because I did get that discount, right? I have to show it on my books. Well, what's the reason why I'm subtracting those $6.25? And there you go. It's the 5% discount because that's what I should be getting. So then when the vendor receives this check, they can double confirm, oh, they took advantage of the discount. Okay.
Mm-hmm.
So in this case, this is how I journalize it, right? I still owe them $225, but I'm taking advantage of the discount. So therefore, I don't write them a check for $225. I write them for $218.75 because I created a kind of like a reverse entry, but in this case, it's a contra account. I'm decreasing my purchase expense by creating a contra account for the purchase discount.
Okay.
Okay. So
Mm-hmm.
therefore, I'm not, like a contra account to a contra account, right? Flows in the opposite direction, right? We originally debited my purchase expense. Now I'm going to credit my purchase discounts because that's money and it's going to readjust your inventory because yes, it is going to affect the actual price that you purchased it for, right? It's going to be discounted at that point. Okay? And that's how we journalize it. Okay? So let's say scenario 2 rolls around, right? And it is now February 15, okay? And you decide to finally pay your Cuppies Co., right? For the amount that you owe, okay? But in this case, right, we missed the discount period. So how much do I actually owe Cuppies Co.? I missed the discount period, so I don't get to take that 5% off.
You owe them the full amount.
You owe them for the full amount. So this is what I'm going to do. Since I owe them, right, and I'm going to pay off what I owe, this is what it's going to look like. I'm going to write a check out for the full amount of the $225, and I'm going to pay them for the amount that I owe. Okay? So in this case, I didn't take advantage of it, right? And this is most likely going to be common for, once again, smaller businesses who isn't sure about their money flow, especially if they're, opening their business at in the very beginning. Like they have other priorities that they have to take care of, right? So they might not be able to just take the discount whenever they can. If they pay, they pay. If they're at the end of their due date, then they just have to pay for the full amount. So any questions there?
No.
Okay. So then let's talk about the net method now. Okay. So once again, that was the gross method, right? We're just recording it as we go and we see that, okay, if I make a payment now, right, then I didn't meet the terms. So therefore, I have to pay for the full amount. Where in this case, right, when we're looking at net method, what we're going to do is we're going to take that discount out immediately. So same scenario, right? Except now, right, we're going to record it at the discounted price. Okay? So since we already calculated what 5% of the 125 is, which is 625, right? Let's go ahead and look at how this one would work. We're going to recognize our purchase expense and our freight expense, but this time we're going to discount it because we're going to take the amount of discount out in the very beginning. Okay, so here I owe Cuppies Co. $218.75 because I'm taking advantage of the discount now. Okay, now once again, these are conditions because that's what terms are, right? It's based on when you make a payment. So in this case, right, I'm assuming I'm so good at paying my bills off. I usually pay my bills off within the first 3 days. So in this case, I'm taking a look at this and saying, hey, you know what? I am I'm going to take advantage of the payment because I'm going to pay them soon. I'm going to pay them within the 10 days. Okay? So if you're that confident and you are that sure, then go ahead and journalize it the way it is, or just in case if you wanted to, you could have just paid right then and there. Okay, but in this case, we're still gonna follow the terms. Okay, so in this case, I owe $218.75. Okay. Now, once again, scenario one, where it is February 9, okay, and we met the discount period. So now we need to pay for our inventory, which in this case, right, we've already calculated that 5% discount from the previous one, right? So all we have to do is just pay what we owe. And in this case, we're going to pay for the discounted amount at $218.75. Okay. So then now scenario two, let's say I end up actually missing the payment and I forgot to pay it. And it's now the 15th and you're still going to make a payment to Cuppies Co. However, right, because you missed that discount due period, right? I have to now enter in another account here to reflect that I have to pay more than what I originally owe because that was the discounted amount. I missed the discount. So therefore, I need to create what's called a contra account. So two contras. So in this case, this is a contra account to your purchase discounts, which is a contra account to your purchase expense. So in this case, that's what I have to do because I recorded it in my books originally at the discounted amount. And now that I passed the discount period, I have to pretty much add it back in. So then now it is a full $225 because that's exactly how much I owe this company because I missed the discount period. That means I got to pay them in full. And in this case, I have to reflect that in my books, I wrote that I originally owe them for the discounted amount. So therefore, I need to add back the $6.25 by creating a contra account to go ahead and enter it in that way. And it's still equal on both sides. Okay? Any questions here? And that is it for chapter 5.1. So what we learned today here is we're going to learn how to practice journalizing our purchases of inventory, okay? So once again, we have our purchases of inventory, right, for periodic inventory. That's our main focus for chapter 5 and chapter 6 is periodic inventory it alone. 7 and 8 is perpetual inventory, okay? So again, when we recognize it, it's going to be purchase expense, freight expense, and if it's placed on an account, you put accounts payable. But if it's not and you purchase it with cash, it will be cash. Okay. The different shipping methods again are your FOB and your COD. And again, shipping point means that the buyer is responsible for the payment of shipping, and then when it's shipping destination, the seller is responsible to pay. Okay. And once again, the difference between periodic and perpetual. And yes, the journals here. What's the difference between the net method versus the gross method? Okay. Let's dive right into our 5.1 exercises. So here we are, 5.1, periodic inventory purchases, exercises, okay? So number 1, okay, journalize and assume that purchases were made on with cash, okay? So number 1 here is on April 5th. April 5th, we purchased a total of 1,000 units at $5 each, with the freight costing me $100. Right? So we're practice journalizing it right now.
The 5th of April.
April 5th.
Purchase expenses.
Mm-hmm.
5,000 in the debit.
Right, 1,000 times $5 is 5,000.
And then the freight cost. Uh, yeah, freight cost or expenses. Okay.
Whatever you want to use. Freight cost, freight expense.
Expense 100.
Okay.
The debit. Mm-hmm. So the total is I forgot. What's in there?
How did we pay?
Cash.
Cash, no? I don't know.
Mm-hmm. We paid with cash.
Yeah, cash. Yes, I say cash. Cash 5,100. Yeah.
Good. Now, this is where I'm going to have you guys, let's see. Okay, in this case, we could practice putting in our little parentheses here, right? So this is normally what would happen. Well, what you're going to do is when you practice journalizing this, right? You're usually going to have the vendor's name and what you purchased. So in this case, I'm going to say purchased 1,000 units at $5 each. Okay?
Mm-hmm.
That's all you got to do. Good. So then what about on April 10, we decided to purchase 750 units at $5.75.
So that would be a debit of 4,312.50 cents.
Okay, what's the account name and how do I journalize it?
Purchase expense.
Purchase expense. Good.
750 units.
Okay, so we got purchase expense.
4,312.5.
Okay. How much was the freight?
75.
So how much total cash?
Less 75 equal 4,385 with 50 cents.
87.
87, sorry, 87, yeah.
Good. In this case, we purchased 750 units at $5.75. Okay. Good. Next example here is that on April 20th, we purchased an additional 200 units at $6 each, with the freight costing $20.
Purchase expenses.
Mm-hmm.
So it was 1,200.
200 times,
6.
at $6.
Yeah,
Mm-hmm.
6, 1,200.
1,200.
Mm-hmm. You
How,
have a $60 expenses spray.
how much?
It's $20, sorry.
$20. Good.
Mm-hmm.
So then what's my total cash?
1,220,000.
Good. Okay. And we're going to fix this because we only bought 200 units at $6 each. Okay. This is useful because if when we do have the next example, we're going to have returns and allowances, right? You need to know how much your actual unit cost is originally because you cannot include freight as a discount or as a return. Okay. Last scenario here is on the 25th of April, we purchased 500 units at $6.25 each, with the freight costing $50. So how am I going to calculate this? What's my total purchase expense? Okay. If I purchase a total of 500 units at $6.25 each,
3,125.
3,125, okay? Plus I have $50 freight. So what's the grand total that I owe?
3,175.
Which I paid in cash. Okay? So again, I only purchased 500 units at $6.25 each. Okay? Good. So that's how we practice journalizing purchases of inventory with periodic inventory, okay? Any questions?
No.
Let's go ahead and move down on the second half of this worksheet here. Number 2, what costs are included when making a purchase for inventory?
Any of the costs associated with
What was that? Any costs associated with?
getting the product to the final store or final destination?
Good. Getting the product, okay, or item or inventory to the store. Okay, so all costs, make that plural. All costs associated with getting the product, item, inventory to the store. Good. So that means freight if there is any, shipping, handling if there's a
Sales
special,
taxes.
foreign fees, storage fees. Okay, all of those are going to be included. Okay. Number 3, what are the 2 tracking methods for tracking inventory?
Pay on board.
This is
No?
the 2 tracking methods,
Oh,
not shipping.
no shipping. Let's see. Oh, I don't know.
Periodic and perpetual.
Periodic
Oh, really?
and
Perpetual?
perpetual, yes. Right? This is the method that we use to keep track of our inventory, right? One is you keep it track often. The other one is you're constantly keeping track of it. Okay.
Please.
Number 4, what does net method mean?
You pay the amount with the discount if you have any discount.
Good. Take the discount.
Okay.
Yes, immediately. Okay. Number 5, okay? Using the gross method for periodic inventory, if you made a purchase on April 5th of 1,000 toys at $5 each with a freight cost of $100 on an account, okay, so that's the keyword here. The vendor gave you terms of a 5% 15 net 30. Journalize this transaction. Okay. So here it's asking you to record it using the gross method for periodic inventory.
First, you record the purchase.
Right, that's exactly what we're doing.
So expenses, purchase expenses.
Good.
So there are 1,000 times 5,000, no?
Yep. 5,000.
I get it. And you have a freight cost $100.
Okay.
So total is 5,100.
Okay. Now how did I pay this 5,100?
Now, with a discount of 15 days,
That's the terms.
terms. But no, when did you pay? I don't know.
How did I pay? What was the key word here?
Oh, let's see.
On account.
What was that, Nancy?
On account.
We paid it on an account, so therefore we have a liability, right? We owe them money. So, accounts payable. Okay? We owe them money. Okay? And because we owe them money, therefore, this terms is going to be applied, meaning if we pay them within 15 days, we'll take the 5% discount. If we don't, the whole entire bill is due in 30 days. Okay? So usually terms will give you a big hint here that it's going to be placed on an account. So in this case, right, you're going to say purchased 1,000 units at $5 each, comma, your terms is going to be the 5%, 15, and if not, it's due in 30 days. Okay? That's just to give you a friendly reminder that you have terms. Okay? Good. So then continue with question number 5. You paid the vendor on April 15. Journalize this transaction or journalize this discount. Okay?
Purchase expenses.
Okay, so we've already recorded that we already purchased the
We buy it.
inventory.
Yeah, but you have the discount. The amount is was 5,000, no? I don't know. Or you did. Oh, see.
Okay? So in this case, right, we're paying off what we owe.
So discount purchase or something like that?
Discount purchase discount is one of the accounts, but it doesn't go first.
We will journal the purchase expense first, the $5,000.
Say that again, Nancy.
We would journal first the purchase expense of $5,000.
Okay, so we've already done that. Okay, that was the first thing that we did right here. We journalized that we made a purchase of inventory, right? That we received the inventory items. So now, right, we're just making a payment.
Gonna pay.
You bring down the accounts payable.
You bring down your accounts payable, so that's correct. So accounts payable, right? This is what you owe. Now, how much do I actually owe?
5,000, but you don't have the discount now.
Yes.
5,100.
Five.
Afraid.
Okay. Good. Now
you have the
I have to pay. I have to calculate what the discount amount is because I'm not going to pay them 5,100.
So you do discount expenses. So
Okay. So so it's purchase discount. Good.
purchase discount. Okay. how much you have? I don't remember. 5% or
It
something like that.
it's 5%.
5%. So like 20 something. I don't know how much is the discount. 20, 26, 25.5.
So it's $5,000 right? Because you can only take a discount off the purchase price. You can't take it out
Oh,
off
excuse
of
me,
the
for
freight.
5,000. So you have 5%. So you have $25.
Okay, one more hundred because it's 5,000, not 500.
250. Sorry.
250. Good.
I know. I know.
Okay, so in this case, 250. So then, therefore, how much am I going to actually pay?
Gonna pay
So
4,000 in cash.
cash or checking. Okay, so here I'm going to pay
4,850. I don't know. 950. No,
Wouldn't it be
what was that, Nancy?
but
no, I did my calculations wrong. I was missing that $100 for freight.
Okay, now in this case, right?
850.
Yes, 850. Because we have a even 100, so we got to subtract 50
Yeah, no, yes,
and then
yes.
200
So,
from there. So 48.50. Okay,
mm-hmm. Yes.
good. And then you can, I guess you could just write pay for purchase on April 5th. Okay, straightforward, right? Check number if there is any. Okay. All right, I'm going to push this one forward so we can see it together. Okay. Question number 7 asks, okay, using the information from question number 5, journalize the purchase using the net method. Okay, so in this case, I'm asking you to journalize the purchase made on April 5th, but this time using the net method. Okay, so once again, let's take a look at question number 5. I purchased on April 5th 1,000 toys at $5 each, with a freight costing $100. And my terms is 5%, 15, net 30. Okay, so how do I journalize that using the net method?
So you write right away that with the discount, the purchase expenses.
Okay, so purchase expense.
So 4,850 plus 100 freight. Sorry, yeah.
So what's that about? What was that calculation again?
So it's 4,850, and you add the purchase rate later, no? Or no?
How do you take out the discount?
The discount it was 5%, but you don't write you write the amount that you. So you take the discount from the $5,000,
Ye-
5%.
Okay, 5. Okay, good. So what is 5% of $5,000? What is that subtracted out?
150. You go and
150.
20, yeah,
So 250 dividing it down to 4,000.
Yeah.
150. Okay.
Okay, so I heard Nancy say 4,750. Good.
750. Yeah, that's fine.
And then your freight expense.
$100. Mhm.
okay, is for $100. So then what is your total accounts payable?
4,850.
4,850. Okay. That's how you journalize that using the net method. That is correct. Good. Okay. Last but not least, question number 8 says, what does terms mean if 2% fit 10 net 20?
You would get a 2% discount if you pay within 10 days. Otherwise, the full amount if you're within 20.
Good. Take 2% discount if you pay within 10 days. If not, you must pay in full in 20 days. Right?
So net 20, it's mean that until you pay on, if you don't pay on 10 days, you don't have the 2%. But
Uh-huh.
or the net 20, I don't understand. Maximum 20 days you have for to pay. That's what you mean?
Yes, maximum days is 20 days. Yes.
Okay, got it.
Mm-hmm.
Thanks.
Mm-hmm. Okay, good job, guys. All right. Any questions for chapter 5.1? Okay, guys, I'm gonna go ahead and take a break right now. So I'm just gonna round it to 2:40. So please be back no later than 3 o'clock.